Well, joining us right now, Nikunj's conversation with Hiren Dved, who's the Director and CIO at Alchemy Capital Management. Nikunj began by asking him if the IT space is now getting more polarized. Also hear out Hiren's top bets for FY13 and business that can show a turnaround soon.
One thing is very clear, that the go-go days of the large cap IT are clearly over. I mean, there is still headroom to grow, but the growth is going to be very slow, and we are essentially taking market share away from other people. So it's not as if the pie is growing very quickly, which was the case, let's say, 10 years ago. So it is at this point in time that differential strategies will have differential results, and that's what we are seeing. Highly polarized, not everybody is doing well. And TCS has been a great standout. Cognizant obviously has been a great standout. But there is an opportunity, I think, that in this difficult environment that we are seeing, and that is in the mid-cap IT space. And partly it has to do with the currency, because the impact of this dramatic depreciation in the rupee has been very positive for the IT companies. At the margin for them, it is far more significant for their delta in profits rather than, let's say, a large cap company. So we've seen a lot of mid cap companies where margins had gone down to single digits are back in healthy mid-teens. Whether it is Mindtree or we saw Geometric. We've seen KPIT, we've seen a lot of other mid-cap companies which have done phenomenally well. And also I think what is happening is that they are all, they are getting enough business. At their size, it makes a difference because they are still doing business in the mid-teens. Unlike the tier one, which is wanting to do only take up business which is 25% plus kind of EBITDA margins. These guys are happy doing business at 15, 16, 17% EBITDA margins. And there is enough of that kind of business which is, kind of going around for them. So these guys are seeing a acceleration, or they are seeing growth, reasonably good growth. There are certain niches and verticals which are doing very well. Engineering services, for example, is a vertical which is growing because, just like what BFSI was a couple of years ago and now slowing down, we are seeing engineering services pick up. That's what we are seeing if you look at Infotech Enterprises or Geometric or again KPIT, that kind of verticals where offshoring is beginning to grow. And some of these companies who are focusing on some of these verticals are also growing and are benefiting from that trend. So I think there is money to be made in the mid-cap IT space because for their size, growth is reasonable. The rupee depreciation is helping margins significantly. And they're not excessively expensive at this point in time. I mean, some of them have now started to trade at, in mid-teens, but there are still opportunities where, these stocks are available at single-digit Ps. They don't have debt on their books, reasonably good management teams. So there is money to be made there.
So you like all the three names you mentioned, Infotech, KPIT and Geometric?
Well, without going to specifics, yeah, I mean, at least two of the three that I mentioned, we do have a position. And yeah, I mean, we like Geometric, we like KPIT. We do have position in both these companies.
So are mid-cap IT companies going through a cyclical upturn or a structural upturn?
I think that, outsourcing isn't going to go away. I think that there is still structural growth, but the structural growth is no longer at that 25-30% compounding. I mean, that's not a given. I think there is structural growth, but the structural growth is at a much lower rate of growth. But there is still growth. And I think that also I think the relative competitiveness of India is improving. For example, we were looking at the chart the other day. Between the Philippine peso, Philippine is a big BPO center and used to compete with India. The Philippine peso has, is appreciated against the Indian rupee by almost 40-50%. So India has now, again become very, very competitive. So I think this currency fall, which has kind of hurted a lot of sectors in the real economy, in the manufacturing sector, has actually benefited certain sectors like tech, pharmaceuticals, exporters, and made them more competitive. So I think there is an opportunity. I think it is still structural. I don't think offshoring is going away. If you hear what TCS had to say, they said that we are still a very small market share in the overall pie, and I think people had largely concentrated on the US geography. I think Europe is now becoming more amenable to outsourcing as compared to the US. Companies that I think could turn around because of either they are changing their business model or they've corrected some of the mistakes that they've made. Glenmark is one such example. They went through a difficult phase. There were issues in terms of their LATAM business underperforming dramatically. There was just too much expectations built in as far as unlocking value in new NCEs was concerned. People just thought that they will just continue to do because they were so successful in their first 1 or 2 attempts. And third, obviously, there were certain accounting issues like capitalization of R&D expenses, and working capital was getting stretched. I think slowly and steadily they've corrected a lot of those. After 3 failures on NCEs, the market was not willing to give any value to the NCE pipeline, and this thing happens in the market. You swing to one end to the other end. So they've corrected some of those. I think the Brazilian business is getting back on track. Hopefully should get profitable this year. They've crunched their working capital down from 180, 190 days to more like 130, 35 days. They've improved their margins. They've started to write off all their R&D in the P&L, and the core business has shown very good health. So I think in situations where people have focused on the problems that they faced and have corrected that, I think there is money to be made, and there was a re-rating potential. So I think clearly, that's one of those kind of opportunities that we looked at. Similarly, we think that in an FMCG space where companies are really valued now pretty richly. We think that with a long-term perspective, with a more like a 3 to 5 year perspective, Tata Global is a clear turnaround story. I think it's moving from an erstwhile plantation company to a branded beverages player. Its traditional businesses were very slow growing, the tea business, the black tea business and the coffee business, but they have made some good acquisitions in the recent past. They've delevered their balance sheet, so there's net cash sitting on the balance sheet, and I think that the return on capital employed profile will change. So people are still giving it a very commodity kind of a PE, but I think that is set to change over the next few years. You're still getting a great branded business, which will do probably 9,000 plus crores turnover next year, with maybe around 8,000 crores, sorry, 8,500 crores turnover with almost about 950 crores EBITDA at a market cap of 8,000 crores. And in that 8,000 crores, you have about close to 1,000 crores of investments, liquid investment, quoted investments and cash. So you're really buying it at a EV EBITDA multiple of 7-8 times as compared to a lot of other companies which are trading at 15 to 20, 25 times EV to EBITDA in that. It's going to be a slow transformation, but I think that it's a very promising one. So I think, there is opportunity in these kind of opportunities where these companies are coming back into their own, they're changing their business model, and I think that is going to drive the PE re-rating in these businesses.
Now, your big call for FY12 was to load defensives, load pharmaceuticals, go easy on infra, and that has paid off. What is your big call for FY13?
I'm quite happy, that even what we call traditionally as defensive businesses are actually high quality businesses. and they are still growing. They are behaving like a strong stock would behave. When the economy has slowed down from 8% to 6 or sub 6%, probably if they were growing at 30%, they're growing at 20%. But they're still generating cash flows. They're able to still squeeze out costs and maintain margins. So relatively speaking, they're still doing better. Elsewhere, things have just collapsed. And it's going to take a lot of time for, those things to come up. And I think that markets do get into this fascination that from the bottom, things are up 30-40% up. But clearly, I'm not going to fall for that bait. So for me, just keep doing what has been working for you. And I'm not going to be a big contrarian just for the sake of being a contrarian.
The minute I say TTK Prestige, there is a spark in your eye. Have you sold your exposure to TTK Prestige? It's been what, a multi-bagger for you? 5-bagger, 6-bagger, how much?
No, it's done quite well for us. We have trimmed some of our holdings, but we haven't sold everything. And I think, I'm going with the adage that you hold on to your winners and cut your losers. So it's been a winner. And while I think valuations are now stretched in the short term, but it's a great company. They execute phenomenally well. I think there is still growth out there. And it also depends, my decision to invest or disinvest depends on what alternatives I have.
Which are very
So if I have some great alternatives, why not? But ideally, I would like to keep my winners.
Okay. Final question. Your son Tanay, who's a teenager, will be an adult soon. So if you have to construct a portfolio for your son, classic stocks, buy stocks for long haul, which are the ones you would like to buy?
I would buy 3M for him. It's very illiquid, but I think if somebody has a 10-year, 15-year view, that's a business to buy. I would buy Tata Global for him. I mean, these are real long-term businesses which will create tremendous value. And there will be several others. I think I would buy some of the retailing stocks, for him. I think the time has come to look at companies like Trent and Shoppers Stop with the next 5 to 10 year view, because there's humongous headroom to grow. They're all available at 3,000 crore market cap still, and the industry can become much bigger from where it is.
Interesting stock ideas there. Trent, Shoppers Stop, Tata Global Beverages and 3M.
Buy them for 5 years. Who has that kind of a time frame? He's a smart guy. I mean, he's picked up a lot of stocks ahead of the curve. TTK Prestige, Vocard. He's hot on Tata Global Beverages because he expects that, the stock is going through some kind of a transition. So watch the way how Tata Global Beverages will move. Ashwini, are you constructing any portfolio for long haul? Are there any stocks you're buying which you are buying right now, you will sell them after 5 years?
Well, buy and hold is probably dead. I'll do much better than him by doing my Nifty and Bank Nifty. So for the day, we have Bombay Dyeing, which is a sell with a stop about 507, target of 480. PF Utilities is a sell with a stop about 425, target of 405. And IGL is a buy with a stop about 244, target of 270. And Petronet LNG, while it may not have much to do with IGL, but I think it's also giving a good breakout on good volume. So even that should be considered as a buy.
Okay, Ashwini, good to have you on the show as always. Individual stocks holding up the market. It's a quiet Friday, at least as of now. It's a good buy then from Nikunj.